Welcome to An Alternate View. I'm Hugh Anderson, and this is some of what caught my attention this week. So do you miss 2021 yet? Don't be too hasty now, because 2022 may not look very much like it. Let's start with this not-so-subtle commentary by Strategas, a well-respected investment research firm that we subscribe to. Quote, lured by the potential for untold riches and encouraged by administrations headed by both Democrats and Republicans, it appears as if some portion of the American business community has entered a post-patriotic world in which dollars and cents count more than old-fashioned bourgeois values like patriotism. China's handling of the COVID crisis and its more bellicose behavior toward its neighbors has more Western investors wondering whether the Middle Kingdom is indeed investable. It's almost impossible to imagine China being seen as a benign force for economic development and geopolitical cooperation than it was a mere 5 years ago. While a generation of MBAs have been taught to be citizens of the world, a realistic assessment of China's power, influence, goals, and motives can only benefit freedom-loving peoples and the companies and employees that serve them. Sadly, and for a variety of reasons, it's unrealistic to expect the business community to lead this charge. Our current political leadership on both sides of the aisle must take the potential threat of China as an aspiring hegemon seriously. Unquote. So tell us what you really think, Strategas. So now let's wander over to our neighbors in Europe. Take a look at what they're paying to heat their homes. Yikes. That's got a sting. Peter Atwater of Financial Insights contends that soaring energy prices could easily be to Europe what soaring food prices were to the Arab nations in the winter of 2011. Food scarcity was the trigger for the Arab Spring, but the extreme underlying powerlessness and uncertainty the crowd felt is what caused the explosive social uprising. People had had enough. On that front, Europe doesn't exactly have a monopoly today. While its energy crisis is front and center, as you look around the globe, there are plenty of other places where feelings of hopelessness are widespread, albeit for different reasons. As one pandemic appears to be ending, the risk is that another is about to explode on the scene, social unrest. But so long as investors view it to be contained to psychologically distant locations like Kazakhstan and Turkey, few will be bothered. But Atwater says we should keep a sharp eye on its path. Should it broaden, it could easily become the next big worry for the market. Moreover, our experience with COVID reminds us that when it comes to tipping points, they don't have to be significant for the crowd to panic. Again, it's the mood, not the trigger, that matters. Shared powerlessness and uncertainty are what lead to uprisings. As some of these macro themes come to a head, be forewarned that market turbulence may well rear its ugly head. No, let me rephrase that. As some of these macro themes come to a head, be forewarned that market turbulence will, and I repeat, will rear its ugly head. We've already seen some rumblings in market action since the first of the year. Alas, some parts of the market have already been taken out to the woodshed. Take a look at these IPOs since last year. The 2021 speculative froth may be abating somewhat, especially as the coyote, chasing Roadrunner, discovers there's nothing below but a lot of nothing. According to Dave Rosenberg of Rosenberg Research, 80% of the stock market rally these past 3 years has been multiple expansion. What that means is only 20% of the gains in the market the last 3 years have come from an increase in companies' earnings, so-called fundamentals. The reason stocks should go up because the company's profits are going up. That 30% number is normally 70%. The rest is that famous clown known as FOMO, the fear of missing out. FOMO fans can't stand the thought of being the only one not making money in the market, regardless of how pricey it's become. My heart goes out to those poor souls. It may be hard to believe, but a 50% decline from its recent highs wouldn't even see the S&P 500 index test its COVID low of March 2020. That would now require a decline of 55%. That's how far we've come in just 2 years. The Fed has managed to blow the mother of all bubbles, otherwise known as Moab. No, not Moab, the beautiful city in eastern Utah. No, this version of Moab was caused by the Fed stoking risk appetites via a mind-boggling amount of money printing. But with that money printing now coming to an end and possibly being quickly shoved into reverse, the whole thing is now at risk of being undone. Even if only the 52% gains in the stock market due to the Fed's balance sheet expansion are at risk, that makes for a potential decline of about 1,400 S&P points or a 30% drop in the S&P according to Rosenberg. But remember, we run to the store when the good stuff goes on sale, and we should do the same when the market goes on sale as well. So that's it for this week. I'm Hugh Anderson. I hope you enjoyed what you heard. I look forward to seeing you next time. Look for us on social media, and stay well.